Good morning and welcome to the trade setup right here on BQ Live. I'm BQ Prime, I'm Idfc, and it's a news heavy day. Let me put it that way. We might have a bit of a bounce early morning, but let's take stock of all of that over the next 10-12 minutes. First, the global news flow. JP Morgan analysts believe that global oil prices could reach $380 a barrel too if US and European penalties prompt Russia to inflict retaliatory crude output cuts. And usually when people make such dire predictions is what marks the top of a commodity. Could this time be the same? Well, there's a difference because there's a conflict going. But yeah, I mean, usually I've seen this in the past that this is what happens. But I thought it was important to bring the JP Morgan view as well. Tesla incidentally deliveries dipped in the quarter, snapping the 2-year streak. You know why this is important, amongst other things, is that we've seen countless stories of how Apple production factories and 200 of them in China were shut due to the COVID lockdown. Now, could all of this reflect in the quarterly numbers from the US companies and companies the world over? I think that's the telling question. Is the issue that Tesla has shown, or is the chink that Tesla has shown, a doing of the supply chain snarls or demand, or a mixture of both? And could that have a bit of an impact on earnings? So I think that's the other thing. Remember, the US markets were up in Friday, but they are closed for the Independence Day holiday today. So you will not have too many cues coming in from the US markets, at least tonight. However, what the US markets did on Friday is relevant for today opening trade, and they did reasonably okay. There was about a % uptick that we saw in most of the US indices or thereabouts. So no complaints per se in terms of other cues as well, be it the dollar index, be it crude, be it Bitcoin prices, or be it the 10-year yields. No great shakes. Yes, the yields certainly came off and came off quite rapidly. Now you're seeing them at 2.88, but I must say, usually yields coming off is a positive sign. Could this time be linked to recession worries or growth slowdown worries? I think that's the key question. So this was, of course, one highlight in the week gone by in the US, that the US yields, the 10-year yield, has certainly come off. The SGX Nifty should be flattish to maybe marginally positive, if at all, or maybe marginally negative. But I reckon that there'll be a move which will be very, very flattish. Yeah, about 26 odd points, right? So hardly any cues there, defending that 15,700 mark for now on a weekly basis as well. And frankly, viewers, you have to admit, I mean, let's bring up the MOV function as well, but you have to admit that, and that market breadth was positive in Friday's session. But this was despite how the oil companies behave. So the point is this, right? That you saw that there was, from an earnings and an index heavy perspective, with Reliance down being 7%, there was a lot thrown at the markets in Friday's session. And yet we didn't buckle down too much under pressure. Now, is that a sign of resilience? That's the key question. To my mind, and let's pull up the trade setup now. To my mind, the index, there is relative resilience seen from the markets, but I still think that the index remains a sell on rise. It's very unwise to think of FI flows ebbing. I think there's a lot of talk around how from very high numbers we've come down to 1,000 crores, 1,200 crores, 1,500 crores, but it's still a sell number. And if you hear people who look at these FI flows very closely, like Mahesh Nandurkar, for example, who spoke to us on Friday, there is a belief that these high sell numbers could well, or sell numbers could well continue into the entire second half for the better part of 2022. Now, can that change? Sure, it could. And we've seen a high number thus far, but it's what, about 5.5% of the total cumulative holding. Can't it go to 6-7% or 8%? And that would mean continuous FI flows on a much lower base. So that's the problem. So to my mind, I think it's unwise to think of there being FI flows, because they could well last into the second half, especially now that earnings could be lower as well. Keep in mind, viewers, that the whole export tax on metal companies, or this windfall tax on oil companies, reduces the earnings delivery for FY23. Those were the sectors that are expected to do well, and those will now come under question. And therefore, the cumulative EPS growth for FY23 is under a serious question, and therefore valuation multiples come under question as well. I would suspect that the wise move would be, if anything, even if you don't want to buy the bottom, etc. And there are a lot of people who will say buy the bottom. I think the wisest move is to stay away from any space which may have an overhang of policy moves. And we've seen this happening now with upstream, right? And for the first time, it's kind of coming into the private sphere as well with Reliance. Now it's in a space which kind of, there is a confluence with the public space, but you just stay away from those pockets, except for Reliance, of course, because it's a small fraction of its overall business. But I'm just saying, any space which may have a policy move danger, stay away from it. Any space which may impact inflation, stay away from it. Banking results might give some resilience to the bank nifty in the near term, which is actually a good sign. Now, there are a lot of queries around IDFC first and some of the others. Since banking is in focus, I'll come to that in a bit. What about stocks to monitor in a session today? And I think that's where the banking numbers will come into play. But I'll start with Avenue Supermarts. The sales were up about 95% YOY at 9,800 crores versus 5,031 crores. The absolute revenues in Q1 were the highest quarterly level so far. Now, this compares, if you just compare this to Q1 FY20, because FY21 was badly impacted by COVID. But compared to Q1 FY20, sales have grown at about a CAGR of about 19% in the last 3 years. That is great news, right? FY21, FY22 impacted by COVID, leave them out. Q1 FY23 compared to Q1 FY20, a strong growth, 19% CAGR. You can't find a wrong fault. You can't find a fault with the delivery numbers from Avenue Supermarts. This is too early. Of course, this is just the initial update. We'll get more details later. But I think this is a strong number. So decent going from Avenue Supermarts. Decent going from banks by and large. So first, IndusInd Bank, Q1 update. Net loans up about 18.4% and 4.4% YOY QOQ at 2.49 trillion. The loan growth in Q1 was the highest in the last 10 quarters. Deposits grew about 13%, which was led by CASA growth of 16% YOY. The CASA ratio for IndusInd is the highest in the last 14 quarters. Strong show. IDFC First Bank. There's a question always about why is IDFC First Bank going despite improvement in CASA and other financials. Well, can these numbers change the fortunes? You could argue standalone that they should, but when you compare it with or juxtapose it with the fact that there are larger franchises which are doing really well, I think in a period of lower liquidity chasing a few stocks, there are performers which are available at a good valuation with a larger market cap and more stability. Maybe that's what the market might want. That is not to say IDFC First Bank won't do well. Frankly, I don't have a view on a stock per se. I'm just saying, just logically thinking, almost everything from an HDFC Bank to ICICI Bank to some of the others like IndusInd Bank are now available at a much better valuation than what they were. And therefore, maybe the first port of call would be some of these banks. Incidentally, speaking of HDFC Bank and HDFC Bank, HDFC merger has gotten one set of approvals. There are still 3 more needed, but that could keep that stock active too in the session today. Federal Bank, Q1 update, not bad either. Gross loans were up about 16.3% YOY. Deposits grew about 8.2%, maybe a bit lower, but led by the CASA growth of 14%. And unlike IDFC First or unlike some of the others, or IndusInd Bank, Federal Bank CASA ratio stayed steady, about 36.8% QOQ, up about 200 basis points YOY, but QOQ was pretty steady. Some other Q1 updates include an NMDC. The sales were down about 28% month on month, down 40% YOY, by the way. Sales for the month, for the quarter, sales were down about 38% QOQ and down about 20% YOY. So not the best of updates from NMDC. In case the stock reacts, you know why. Some other stocks include Hero MotoCorp and TVS Motors, wherein in Hero, sales were up about 3.34%, but 4.84 lakh units is almost in line with estimates of 4.9. And TVS Motors, sales were up about 22% YOY at 3.08 lakh units, which was again almost in line with estimates. The domestic sales included the sales of the EV business, which recorded highest ever sales numbers of 4667 units, a 77% growth over May. So Hero in line, maybe marginally lower. TVS Motors in line, maybe marginally higher, but strong numbers from TVS, which is actually a good sign. Deepak Nitrite could be interesting. The Gujarat Pollution Board Control board has allowed now the nitro section to operate at 50% capacity post the corrective actions taken by the company. The stock has been hammered out of shape for all the right reasons, by the way. Maybe this gives a bit of relief for the stock. So maybe it reacts today. I don't know. But if it does, you know why it is doing that. Then the big elephant in the room, right? The upstream companies, ONGC, Reliance, which are the key culprits of Friday's session. Now, here's what brokerages are saying, and I've brought you the most relevant thoughts that I thought were relevant at least. So Jeffrey's note on Reliance is interesting. So they have a buy. The target price has been cut to 2,900. The points that they make are important. They are saying that this unprecedented move to cap refining profits of private refiners like Reliance as well impacts their belief on this. They believe the impact of move is a 4% cut to their estimates of FY23 EBITDA. I could argue with this. I think the cut is probably a bit more, but let's assume that Jeffrey's analysis is better than mine, and they believe it's a 4% cut to FY23 EBITDA, which is fine. But they say that while there is no reason to cut the refining EBITDA for FY24, the intervention prompts them to cut the valuation of the multiple to 7 times from 8 times. Marginal peaks out there, and which is why this is happening. By the way, to a lot of people and to me as well, when I analyzed after looking at a lot of other numbers, maybe the cuts are a bit more, and maybe Reliance could remain under a bit of pressure as well. Though today is a day of a bounce, so maybe you see some of these stocks bounce back too. Don't know. Here again, one of the early bulls on ONGC, for example, JP Morgan, has downgraded the stock to a neutral with a target price of 155 from 210. That's a sharp gash. They are saying that they see imposition of this large fixed additional tax as sharply negative, given that it is not linked to oil prices and there is no clarity on when the tax would be removed. It's a very fair argument. They are refraining from an outright underweight because they believe that the near-term dividend yield could provide some downside support. But there's a 32% EPS cut for FY23, 26% EPS cut for FY24. And why I say this is important from JP Morgan's perspective, because they were some of the earliest bulls on ONGC and Oil India. They've stayed bullish throughout. And now that analyst, I think Pinakin Parekh, is now cutting back on his bullish optimism. That is actually a really stark call there. Goldman Sachs believes that they have a buy with the target price of 210. Now, they are, of course, comparing this with what is available in the whole region. So they are saying that the windfall tax was a surprise, but the risk reward remains favorable. They lowered their EBITDA by 23%, again, right, in line with some of the others, 23% EBITDA cut for FY23-24. And they see a free cash flow and 11% dividend yield in FY24, which is what keeps them bullish, because they believe it's much higher than the APAC average. Now, could ONGC give that much of a dividend? Remains to be seen. Dividend yield of 9% and 7% respectively. Who knows if that happens or not? So, a lot of assumptions and differing views as well, right? If you see JP Morgan early bull slashing it to an underweight or a neutral rather, excuse me, and Goldman Sachs maintaining a buy. Depends on which argument you believe. You might want to believe that all the pain is already in the price. Who knows? I would suspect that people would want to stay away from policy overhang stocks, and therefore we might not see large cumulative buying into any of these. Lastly, more importantly, viewers, keep in mind what may happen, and it just stood out for me, right? It's a whole chart-based story on Bloomberg which speaks about how there's a slowdown in factories from US to Asia. Manufacturing has certainly slowed down as factories struggle to struggle with supply chain snarls, labor shortages, and elevated material costs. So there's a bit of a slowdown happening in manufacturing per se, which is the bulwark of a lot of people's bullish argument. We know that there could be a slowdown in consumption in the US and maybe in the other parts of the world as well, as there is a doubt around the strengths of the economy. If all of this is put together, and then there is a fear about how earnings might grow as well in the first place, you might be hard-pressed to figure out a bullish argument, which is very bullish, despite the fact that the valuations are a lot better than what they were. It doesn't seem all hunky-dory, but the start today could well be good. Banking could hold out. I doubt that metals will give support. It could be very well left to banking being the last resort. And if TCS somehow manages to pull out a rabbit out of its hat and give a positive commentary and a good delivery when it comes out with its results on Friday. So I think that is something that the street would be fervently hoping for. Let's wait and watch how it shapes up. Have a good day, stay safe, and hoping for some resilience from the equity market.